As a dividend stock investor, I enjoy looking back at the previous month to see how much I was able to reinvest into the stock market. In October, which was a great month for me, I was able to buy the equivalent of one share of Royal Bank of Canada, ticker symbol RY, which is roughly $128. At the end of this video, I'll talk to you about all the different shares that went into growing that $128. Now, $128 a month, and that's roughly the average. Actually, that's above the average, is not much to go on. But my long-term goal with these dividends is to grow it as a source of passive income. So by my math, typing stuff into a spreadsheet, coming up with the right formulas, in 20 years, I should have over $1 million saved up in my tax-free savings account. With that $1 million, at the current portfolio yield, which was around 5.4%, that means I will have over $50,000 a year of passive income that I can do whatever I want with. Really enjoy my retirement, going on some amazing vacations with my wife, spoiling my children and grandchildren, and not having to make small little decisions of like, should I buy this, should I buy that? And definitely, canceling Disney Plus is not on the table. That's so awkward. But what's going to happen to that plan and those dividend payments if we go into a recession in 2023? Am I still going to be able to make $1 million? How reliable are dividend payments during a recession? Those are some of the questions I have, and so we're going to explore some of those answers based on some of the research that I did. But first off, introductions. How's it going, everybody? I hope you and your investments are doing well. My name is Steve, and I am a dividend stock investor putting $150 every week into my tax-free savings account to grow some passive income, with the goal of having some sweet financial freedom. It's a long road, and there's definitely going to be some bumps up ahead, and this upcoming 2023 recession might be the first significant one. The markets are down right now, but this is maybe a different ball game, but we're about to head into. So I want to know what's going to happen to my portfolio, to my dividends, to my plan. So let's talk about that. Now, my personal portfolio is made up of roughly 76% individual dividend paying stocks. The other 24% is made up of an ETF. It's the Vanguard Canadian High Dividend Yield ETF, VDY. So I am 100% in the dividend game. So this is something near and dear to my heart. This is my research. Please do your own financial investigations. This is not financial advice. This is for entertainment purposes only. So let's get on with it. Companies that pay dividends tend to be less risky. They have a greater cash flow, which allow them to keep paying out those dividends. One easy way to find those companies is to look up the Dividend Aristocrat listings. So in the United States, we're talking about companies like Coca-Cola, McDonald's, Target, and there's a ton more on the list. In Canada, we're referring to companies like Manulife, Enbridge, and TD Bank. Again, there's a lot more companies on that list that you should take a look at. And these are companies that have been consistently paying out a dividend and have consistently been increasing their dividend yield even when times get a little rough. Compared to the overall market, dividend stocks tend to perform slightly better. Now, that's not always true in every situation, but in some of the major economic slowdowns, that has proven true. Some significant ones are July 1981, March 2001, and December 2007. But if you look at 1980, at the beginning of this graph, the US Fed was trying to fight inflation. So they had been raising the interest rates, and that's when some of the dividend stocks kind of got hurt a bit. Another way to make sure that your dividends kind of keep coming in is to be ultra aware of what the dividend yield is of a company. If that dividend yield is already really high, and I'll use Corus Entertainment, a favorite example, as one that is really high right now. It's around 11%, 10, 11%, depending on the price. If the stock market does drop, and let's say, does it drop by 25%, 30%? I really don't think that that company is going to continue paying out the dividend that it is. So that would be a dividend that I could see being at risk of being cut because it's already very, very high. Now, compare that to Royal Bank of Canada, which has a dividend yield just around the 4% mark. Again, depending on the price of the day, it has a lot more wiggle room to, increase their dividend because it's not such a significant part of the overall stock price that one is probably not going to be touched. And again, that's one that's actually on the Aristocrat listing of dividend stocks. So which dividend paying companies are part of your portfolio definitely matters because it's not across the board just because you invested in a dividend company that it's going to continue paying you those dividends. It's just simply not that case. Let's talk about the dividend payments themselves. When you look at the S&P 500 going back to World War II to today, there has been 11 recessions and bear markets. So in that time period, the average drop of a dividend payment was 0.5%. So it's pretty safe to say that those dividends are pretty consistent. And as long as you're diversifying yourself or buying a good quality ETF that, again, is diversified, you really don't have to worry too much about those dividend yields going down. Of course, past performance does not predict future performance, so take all that with a grain of salt. My plan is to keep reinvesting those dividends in 2023, regardless of what's going to be happening. I plan on keep putting money into the stock market every single week. And if a recession happens and if the stock market drops 30% more from what it is right now, or if that's 30% from its highs in 2021, whatever it might be, that is a buying opportunity. So I can buy some additional stocks then. And the cool thing is that generally, after there's been any major economic slowdown, within the following 12 months, there is major economic growth. So the value that I'm getting from keeping investing in during the recession in the following 12 months, I could see those investments double, perhaps. So that is definitely going to get me to that $1 million goal in 20 years. We really don't know, do we? We don't really know. A recession, for a lot of us here, just starting out, age 25, 35, 45, this recession might be a golden ticket to really take advantage of this opportunity to grow our portfolios. And so that when the market does recover, we are in a better position. So all of us can go on vacation together. No, I'm joking, and all of us can keep our Disney Plus subscriptions and enjoy some nice, amazing passive income and really grow our wealth. Let's go over the companies that I invested in that paid me a dividend in October. So I need to refer to my notes here. And they are Aecon, ticker symbol ARE, and that was $20.35. Next was Ryokan, ticker symbol REI.UN, and that was $5.02. They are a monthly paying REIT, so that's why it is a lot lower. The next one is VDY, that's the Vanguard High Interest Dividend Canadian Yield. I think I mixed up the order there. And that was for $24. So this is a nice big, again, this is monthly paying, so this one is very nice to own. Then we got AQN, that was for $17.06. Pizza, this is another monthly paying company. It is $5.94. Bell Canada, $17.48. That's ticker symbol BCE. Energect Renewables, ticker symbol INE, that was $11.16. And BNS, $18.54. And last but not least, we have Diversified Royalty Corp with $9.40. Thanks for watching, everybody. I hope you enjoyed this video. I enjoyed making it. In fact, actually, I filmed it 3 different times. Mic wasn't plugged in, battery died on me, and finally, hopefully this version that gets uploaded without delay. So I enjoy making these videos for you, thank goodness, because I was pulling my hair out quite a bit. So keep it in the green, everybody. Don't forget to like and subscribe. Don't forget to do that. We'll see you in the next video, and we'll talk to you later. Bye.